been tempted by a bond offering higher returns than your regular fixed deposit? You're not alone. It's easy to think more returns means you will reach your financial goals faster, but here's the truth. Higher returns usually bring higher risk along for the ride. In the last few years, a lot of investors have started searching for something that sits in between. Better returns than an FD, but without going all in on risky investments. That's where online platforms like Bonds India have been making their pitch. High yield bonds, easy access, and the promise of a smooth investing experience. But is it really that simple? Let us break it down. So hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decisions to reach your financial goals in a more faster and smarter way. So now let us first understand what are bonds. A bond is simply a loan you give to a borrower. It could be the government, a company, or even a bank, and they promise to return your money with interest. But before you jump in, you need to ask, what if they default? What if interest rates change? And what if I need my money back before maturity? Government bonds are the safest, but they often can't beat inflation. Corporate bonds can offer higher returns, but the trade-off is higher risk. So that's where credit ratings come in. Agencies like CRISIL, CARE, and ICRA rate issuers from AAA, which is the safest, down to D, which is defaulted. But here's the truth. Ratings are helpful, not bulletproof. Remember ILNFS, DHFL, Yes Bank, 81 bonds? They were all rated before things went south. Another key detail, the type of bond. A senior secured bond gives you first claim on collateral if the issuer fails. Unsecured or subordinated bonds, so you're way down the payment queue. And perpetual bonds, they may never mature at all. So even if a bond is listed on a SEBI registered platform, safety depends on the bond itself, not the website. So there's credit risk, liquidity risk, and the temptation of flashy high yield offers that may hide higher risk. So knowing all this, how do online platforms like Bonds India actually fit into the picture? They don't remove the risk, they simply make bond buying more accessible. So the real safety still depends on what you buy, not where you buy it from. So with that in mind, let's take a closer look at Bonds India, how it works, the type of bonds it lists, and the things you should check before deciding whether any bond on it is right for you. So now let's take a look at the platform overview. So Bonds India is run by Launchpad Fintech Private Limited, is basically a digital marketplace for fixed income securities. It feels like a one-stop shop, but here's the reality check. Does using the platform mean zero risk? Does regulatory oversight equal a safety guarantee? Should you rely only on its filters to choose your bonds? The truth, the regulations help reduce fraud, but they can't remove the chance of a default. The responsibility for due diligence, that's still yours. So what can you actually invest in here? You have got bonds with filters for coupon rate, tenure, credit rating, and face value, so you can match them to your goals. Next, bond IPOs. Details on current and upcoming issues from issuer name to subscription stats. Number 3, GSEC strips. So zero coupon versions of government bonds, where interest and principal trade separately. 454 EC bonds for saving on capital gains tax if you have sold property. And number 5 is corporate FDs from names like LIC Housing Finance, Kotak Mahindra Bank, and HDFC Bank. On paper, that's a wide menu, but the real question, which of these fit your financial plan and which don't? Interest can be paid monthly, quarterly, or semi-annually. Sounds flexible, right? But ask yourself, will you reinvest that interest or just let it sit? Because without reinvestment, compounding slows down. And yes, if the issuer's cash flow takes a hit, payments can be delayed or skipped entirely. With a minimum ticket size of just 10,000 rupees, the platform is open to almost anyone. But accessibility doesn't mean always suitability. So if this money is your emergency fund, you might be better off in something more liquid. These products work best when they are a planned part of your portfolio, not a random add-on. So some of the Platform features are there's quick KYC, a variety of products, and even a 7-minute investment promise. So it's designed to be frictionless. But here's a question: does convenience make it too easy to skip the homework? The platform can help you transact faster, but it can't decide if the investment is truly right for you. So, who might these platforms be suitable for? They are designed for investors willing to take on higher risk in search of better returns than traditional fixed deposits or government bonds. That means aggressive savers aiming for above average fixed income returns, investors adding a high risk debt component for diversification, people with surplus funds after meeting their primary goals. So before you click that invest now button, ask yourself, can I handle the risk of default? Can I stay invested till maturity despite low liquidity? What's my backup plan if the platform shuts down? Or does this fit into my financial plan, or am I just chasing yield? So pro tip, only allocate here after you have built your emergency corpus and secured your core investments. So here high returns often come with hidden cost, and in bonds taxes are one of them. Interest income from bonds, they are taxed at your slab rate. Capital gains taxed differently depending on whether they are listed or unlisted and whether they are short term or long term. So before chasing that extra 2 to 3% yield, ask yourself, will it even beat inflation after taxes? Bond platforms love saying better than FD, safer than equity. But here's the reality. Yes, equity funds can be volatile, but they rarely default. Markets tend to recover over time. Bonds, on the other hand, can deliver a permanent loss if the issuer defaults. We have seen it happen also. DHFL, ILNFS, S-Bank 81 bonds, investors lost crores. So even senior secured bonds can fail if collateral values drop or recovery drags on for years. So equity mutual funds, especially large cap or hybrid ones, offer diversification, liquidity, and SEBI regulated fund management, giving them resilience in the long run. Remember April 2020? Franklin Templeton shut down 6 debt funds overnight, freezing 25,000 crores. And these weren't failing funds. They had great past performance. But when the market froze, their illiquid debt holdings couldn't be sold. So if this could happen under a reputed AMC with SEBI oversight, imagine the risk when you're lending directly to lesser known companies through a bond platform. So TrueCap Finance once promised over 13% returns backed by small businesses and gold loans. Sounds irresistible, right? But when defaults rose, credit ratings dropped, and liquidity dried up, the illusion shattered. By July 2025, TrueCap defaulted, so high return is high risk. Credit risk is like an earthquake, unpredictable but devastating. Smart investors don't just ask what's the return, they ask can this survive a crisis? And often a well diversified mutual fund portfolio managed by experienced professionals is far better equipped to handle those shocks. Here's the thing you must understand: SEBI registration simply means the platform is a compliant intermediary. It does not mean your investment is risk free. The actual risk lies with the issuer of the bond, not the platform selling it. So while the interface might look modern, the reality is your money is still tied to the credit worthiness of the company borrowing it. So here are some of the big risks nobody talks about. Number one, credit risk. Many of the high yield bonds listed online are lower rated. The higher the promised return, the higher the risk of default or delayed payments. Are you being compensated enough for that risk? And then liquidity risk. Some bonds are illiquid, meaning if you want to sell before maturity, you may not find a buyer. So that's a risk mutual fund investors don't face because funds handle liquidity for you. And third, misleading yield focus. Platforms often highlight just the attractive interest rates, but do they equally highlight the possibility of loss? Not always. So here's the thing: SEBI registration doesn't mean guaranteed safety. BondsIndia, like other bond platforms, is SEBI registered as an intermediary, not as a guarantor of risk-free returns. So defaults are real and they are not rare. Just look at DHFL, ILNFS, Yes Bank 81 Bonds, SREI Infra, or Reliance Home Finance. Investors chasing yield in those cases took heavy losses. A slick, user friendly interface doesn't reduce your risk, so always read the fine print and dig into the issuer's financial health before investing. So, what is the final takeaway? If safety is your priority, RBI Retail Direct offers government bonds with sovereign backing and zero platform fees, a much safer bet. Also, liquidity is a big deal. Many bonds trade in low volumes, so exiting before maturity can be difficult or costly. And finally, diversify. Don't concentrate. For most investors, diversified debt mutual funds or government bonds are far safer than locking large amounts into one company's bond. So, also remember, a certified financial planner can help you structure your debt portfolio intelligently. That means balancing potential returns with real world safety, liquidity, and most importantly, your actual life goals. So, don't risk your peace of mind for a few extra percentage points. Get expert advice before you lock in your money. So, if you would like a free consultation with one of our certified financial planner, click the link in the description, and of course like, share and subscribe to our channel for more unbiased investing insights like this. So thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.